$15 trillion didn't disappear by accident. It was wiped out. Across metals on Friday, across crypto over the weekend. And that timing matters more than the number, because this wasn't one market failing. This was liquidity leaving the system. When assets that are supposed to behave differently all move the same way, you're not watching price discovery. You're watching stress. Gold sold off. Silver snapped. Crypto unraveled. Not slowly, not methodically, violently. That tells you something broke under the surface. This wasn't about fundamentals changing overnight. No new law was passed, no war suddenly ended, no debt vanished. What changed was positioning. Too much leverage, too much confidence, too much assumption that liquidity would always be there. And when liquidity pulls back, everything reprices at once. Friday's metal sell-off was the first signal. Gold and silver don't usually lead crashes. They usually absorb fear. So when they sell off hard, it's not because they're weak, it's because someone needs cash. Fast. Metals are liquid. They trade deep. They're easy to sell into size, so they get hit first. Then comes the weekend, when traditional markets are closed, when risk can't be hedged normally, when crypto becomes the pressure valve. And that's exactly what happened. Crypto didn't crash in isolation. It absorbed what couldn't be sold elsewhere, forced liquidations, margin calls, risk managers hitting the button. This is what de-risking looks like in real time, not panic headlines, not fear tweets, but synchronized selling across assets that are owned by the same players. That's the key most people miss. It's not retail driving these moves. Retail doesn't control $15 trillion. Institutions do. And institutions don't sell because they're scared. They sell because their models tell them to. VAR limits breached, correlation spikes, liquidity assumptions fail. When those triggers hit, everything goes. Gold, silver, crypto. That's not bearish sentiment. That's systemic behavior. And here's the uncomfortable part. Events like this don't end with a weekend. They carry forward. Which brings us to Monday. Because Monday isn't about what already fell. It's about what still hasn't repriced yet. Monday is where reality sets in. Weekends create the illusion that damage is contained. Charts freeze, commentary pauses. But risk doesn't stop moving just because markets are closed. It accumulates. By the time Monday opens, positions that survived Friday and the weekend are suddenly forced back into the same room. And that's when repricing accelerates. The most dangerous thing after a wipeout is assuming the worst already happened. Because the first move is usually about liquidation. The second move is about alignment. Assets that didn't sell off enough are forced to catch up. Assets that sold off too much either stabilize or gap violently in the opposite direction. That's why Monday openings after systemic events are rarely calm. Over the weekend, risk managers don't sleep. They rerun models. They adjust correlations. They reduce exposure. And when markets open, those decisions hit all at once, not gradually. At the open. This is why gaps form. This is why bids disappear. This is why volatility spikes before news even hits. Because the news already happened. The market is just processing it. Another thing to watch closely, what doesn't bounce. After big wipeouts, weak assets try to rally quickly. Strong assets hesitate. That's counterintuitive, but it's how capital preservation works. If buyers are unsure about liquidity, they don't rush back in. They probe. Small size, wide spreads, low conviction. That's not bullish behavior, but it's not bearish either. It's cautious. And caution tells you confidence hasn't returned, which means risk remains elevated. This is also when narratives start shifting. Friday was profit-taking. The weekend was overreaction. Monday becomes, what if this is something bigger? That transition matters, because once the narrative changes, flows change. And flows move markets more than opinions ever will. Another red flag to watch. Correlation. If gold, stocks, and crypto continue moving together, it means liquidity is still the dominant force. And when liquidity dominates, diversification stops working. That's when systemic risk becomes visible. Not because everything's crashing, but because everything's behaving the same way. That's not normal market behavior, it's stress behavior. This is where the market stops being loud and starts being honest. After a wipeout like this, price action alone won't give you answers. Volatility already did its job. What matters now is behavior. Do buyers return quickly, or do they hesitate? Do rallies get sold, or do they hold without urgency? Those questions matter more than any headline. The system just flushed leverage. That doesn't mean risk is gone. It means risk has been revealed. When $15 trillion is wiped out, someone's balance sheet is lighter. And lighter balance sheets change behavior. Capital preservation replaces risk-taking. That shift doesn't reverse overnight. This is the phase where markets test stability. Not with crashes, but with silence. Low volume, tight ranges, unconvincing moves. That's not boredom. That's assessment. Institutions don't rush back in after stress. They watch. They wait to see who is still standing, who needs liquidity, and who is pretending everything is fine. Another thing to understand, the most dangerous phase isn't the crash. It's the false calm that follows it. That's when people assume the system absorbed the shock. But absorption takes time. Losses don't disappear. They move from one balance sheet to another. And until that process settles, volatility remains latent. Which brings us to the bigger picture. This wasn't just metals. This wasn't just crypto. It was a reminder that liquidity is the true asset. And when liquidity tightens, everything else becomes secondary. Gold didn't fail, silver didn't break, crypto didn't suddenly lose relevance. They all reflected the same thing. Stress. The market is now asking a simple question. Is this a reset or the beginning of a deeper repricing? The answer won't come from price predictions. It will come from correlation breaking, volatility compressing, and confidence returning quietly. Until then, discipline matters more than conviction. Understanding matters more than opinion. And patience matters more than being right. The people who navigate moments like this aren't the ones calling bottoms or tops. They're the ones respecting uncertainty and staying solvent long enough to benefit when clarity finally returns. Because cycles don't end with panic. They end when stress is absorbed. And right now, the system is still absorbing. There's one final mistake people make after events like this. They assume markets owe them clarity. They don't. Markets only reveal information to those who know where to look. And right now, the information isn't in price targets. It's in restraint. After massive wipeouts, the system becomes fragile in a different way. Not explosive, but sensitive. Small events create large reactions. Minor headlines move markets. Rumors travel faster than facts. That's not coincidence. That's what happens when confidence hasn't fully returned. In these phases, markets punish impatience more than fear. People who rush back in looking to make back losses quickly usually become liquidity for someone else. That's how cycles transfer wealth. Not in one dramatic moment, but through repeated emotional decisions. Another truth that's hard to accept. The biggest opportunities don't feel obvious, they feel uncomfortable. They require waiting while nothing seems to be happening. And waiting feels wrong in a world trained to react instantly. This is where discipline becomes the edge. Not leverage, not predictions, not conviction. Discipline. Knowing when not to act is more important than acting fast. Right now, the system is recalibrating. Balance sheets are adjusting, risk limits are being rewritten, assumptions are being questioned. The process doesn't show up on charts, but it dictates what comes next. This is why veterans don't rush to declare victory or defeat after wipeouts. They know the real test comes later, when volatility fades, when attention disappears, when participation drops. That's when the cycle quietly turns. Not with a bang, but with a shrug. And by the time confidence returns, the easy positioning is already gone. The people who benefit from these moments aren't braver than everyone else, they're calmer. They respect uncertainty, they protect capital, they let the system reveal itself. Because financial cycles don't reward urgency. They reward endurance. And the only way to endure is to understand that chaos isn't the end of the cycle. It's the transition. What happens next won't announce itself loudly, but it will matter more than what just happened. And those who are still paying attention when nothing seems important are the ones positioned when everything becomes obvious again. This is where the cycle completes its lesson. Not by predicting what happens next, but by revealing who learned something. Moments like this divide participants into two very different groups. Those who react and those who observe. Reaction feels productive. It feels like control. But in financial cycles, reaction is usually how losses compound. Observation feels passive, uncomfortable, almost irresponsible. Until it isn't. Because cycles reward those who understand. Timing is not about speed. It's about alignment. Alignment with liquidity. Alignment with risk. Alignment with reality. The past few days stripped away illusions. Illusions of constant liquidity. Illusions of diversification without correlation risk. Illusions that markets move independently. What was left is truth. Liquidity rules. Leverage amplifies. Cycles correct excess. That's not pessimism. That's structure. And structure doesn't care about narratives. It only responds to imbalance. Right now, imbalance is being corrected. That doesn't mean opportunity is gone. It means opportunity is changing shape. Fast money already moved. Emotion already burned off. What remains is slower, more deliberate. This is the phase where capital is preserved, not multiplied. Where patience becomes a strategy, not a weakness. History shows this clearly. Every major financial cycle has a moment where losses force reflection, where speed gives way to caution, where noise gives way to silence. And silence is not emptiness, it's preparation. The next chapter won't start with a dramatic headline, it will start quietly. With stability returning in places, most people stopped watching. With correlations breaking, with volatility compressing, with confidence rebuilding slowly. Those are not exciting signals, but they are powerful ones. If you understand that, you stop trying to outsmart the market. You let the market show you when it's ready. Because cycles don't reward impatience. They reward those who stay solvent, stay curious, and stay disciplined long enough to see the next phase clearly. This wasn't the end of anything. It was the middle. And in financial cycles, the middle is where the real decisions are made. This is where everything slows down enough for the truth to surface. Not the truth of headlines, the truth of positioning. After a cycle like this, markets don't reward prediction. They reward awareness. Awareness of what changed and what didn't. Prices moved violently. Confidence was shaken. Leverage was punished. But the system didn't reset its foundations. Debt didn't disappear. Currencies didn't regain discipline. Structural pressures didn't resolve themselves. Those forces move on longer timelines. And that's why short-term chaos often disguises long-term continuity. Most people mistake volatility for direction. They think sharp moves mean conclusions were reached. In reality, sharp moves usually mean questions were raised. The system just asked who is overextended, who is dependent on liquidity, and who can survive uncertainty. That question echoes forward. It affects lending. It affects risk appetite. It affects capital allocation. And those effects compound quietly. The next phase won't be obvious. It won't come with sirens or emergency headlines. It will show up in small shifts, in how fast fear fades, and how quickly confidence returns, in whether markets respect bad news or ignore it. Those details matter more than any single candle. This is where understanding cycles becomes an advantage. Cycles don't move to reward participation. They move to correct excess. And once excess is corrected, they pause. They let time do the work. Emotion can't. People who survive these moments don't rush to reclaim losses. They reassess. They adjust exposure. They reduce assumptions. They widen their perspective. Because the goal isn't to win the next move, it's to still be standing when the next trend becomes undeniable. This is the discipline most never develop. They chase clarity. They chase certainty. But cycles never offer those up front. They offer them only after patience has done its job. What just happened wasn't a verdict. It was a reminder. A reminder that markets are systems. That systems correct imbalance, and that cycles don't care who understands them. They only reward those who respect them. If you can do that, you don't need to predict Monday or next week or the next headline. You let the cycle reveal itself, and when it does, you're still here to see it. This is where perspective becomes power. Not because you know what happens next, but because you understand how things happen. Financial cycles don't announce transitions. They reveal them through behavior over time. Right now, the system is in between states. Not panicking, not confident, cautious. That's a fragile phase. In fragile phases, markets don't reward boldness, they reward restraint. The biggest danger now is mistaking relief for resolution. A bounce doesn't mean safety. Stability doesn't mean strength. It only means the system is catching its breath. History is clear on this. After every major wipeout, there's a period where nothing dramatic happens. And that's where most people disengage. They assume the story is over. They assume the opportunity passed. But cycles don't end with action. They end with apathy. When nobody cares, when nobody's watching, when conviction fades into indifference, that's when positioning quietly rebuilds. Not with leverage, not with excitement, with patience. This is why understanding cycles isn't about forecasting tops or bottoms. It's about recognizing phases, expansion, stress, correction, absorption. We're in absorption now. Losses are being digested. Risk is being reevaluated. Assumptions are being challenged. That process can't be rushed. And trying to rush it usually creates new mistakes. The people who do well long-term aren't immune to volatility. They're fluent in it. They don't ask, how do I avoid this? They ask, what is this phase trying to teach me? Because every cycle leaves a lesson behind. About leverage, about liquidity, about behavior under pressure. Ignore those lessons, and the next cycle is more painful. Learn them, and the next cycle becomes opportunity. What matters now isn't calling the next move. It's staying aligned with the rhythm of the system. Because cycles always move forward. They just don't move on our schedule. And when this one turns, it won't reward the loudest voices. It will reward those who stayed disciplined when discipline was hardest. That's how financial cycles separate participation from mastery. And that's why understanding the cycle matters more than predicting the next headline. This is the final shift most people never notice. The moment when the cycle stops feeling threatening and starts feeling instructive. By now, the shock has faded. The headlines have moved on. The urgency has cooled. And that's exactly when the real work begins. Not in the market, in mindset. Because cycles don't just move prices. They reshape behavior. They teach restraint. They punish shortcuts. They expose assumptions. And once those lessons are delivered, the cycle doesn't need to shout anymore. It whispers. This is where long-term advantage is built. Not by predicting the next spike, not by timing the perfect entry, but by understanding where you are relative to the cycle itself. Right now, we're past reaction and before conviction. That space is uncomfortable. There's no clarity, no confirmation, no crowd to follow, which is why it matters. Most people only feel safe when everyone agrees, but agreement always comes late. Cycles reward those who can act without applause and wait without reassurance. That's not easy. It requires perspective. Perspective that sees volatility not as danger but as information. Perspective that understands losses are not failures but tuition. Perspective that knows cycles don't end because people are ready. They end when excess is gone. And excess doesn't disappear quietly. It leaves scars. Scars on charts. Scars on confidence. Scars on participation. Those scars are signals. They tell you where risk was misunderstood, where leverage was abused, where certainty was misplaced. Ignoring them is how mistakes repeat. Learning from them is how cycles stop hurting and start working in your favor. This is why financial history matters. Not for dates or predictions, but for pattern recognition. Every cycle has a moment where patience becomes the edge, where doing nothing is the most disciplined action, where survival becomes strategy. If you understand that, you stop fighting the market. You move with it. And when the next phase emerges, as it always does, you're positioned not just financially, but mentally. That's the difference between participating in cycles and mastering them. Because the market doesn't reward urgency. It rewards alignment. And alignment only comes to those who respect the cycle long after the noise fades. This is where everything comes together, not as a prediction, not as a call to action, but as understanding. Financial cycles aren't puzzles to be solved. They're forces to be respected. What just happened wasn't chaos, it was consequence. Consequence of leverage built too high. Consequence of liquidity assumed too freely. Consequence of confidence stretched too far. Cycles always correct those things. Not out of malice, out of necessity. And once the correction happens, the cycle doesn't end, it evolves. Right now, the system is in a reflective phase. Capital is cautious, risk is selective, confidence is conditional. That doesn't mean opportunity has gone, it means opportunity has matured. This is the phase where noise fades and signal strengthens, where the crowd loses interest and structure becomes visible. That's where long-term positioning is built. Not on emotion, not on headlines, on patience. Most people will never experience this phase fully. They'll disengage too early. They'll move on to the next story. And that's fine. Markets don't need everyone. They only need imbalance. And imbalance is already forming again, quietly in places few are watching. That's how cycles work. They never end with resolution. They end with indifference. And indifference is the soil where the next trend grows. If you understand that, you stop trying to win every move. You start focusing on survival, clarity, and timing. Because those are the real edges. This series wasn't about fear. It was about perspective, about seeing past volatility into structure, about understanding that markets don't punish participation. They punish misunderstanding. And they reward those who learn the lesson once instead of paying for it repeatedly. The cycle is still turning. It always is. And when the next phase becomes obvious, it will feel sudden, but it won't be random. It will be the result of everything happening quietly right now. If you're still paying attention, still patient, still disciplined, you'll recognize it. Not because someone told you, but because you understand how the cycle moves. This is the point where the cycle stops being external and becomes internal. Not about markets, about behavior. Because every financial cycle ultimately tests how people respond under pressure. Not when things are easy, but when certainty disappears, what separates outcomes isn't information, it's discipline. Most people had access to the same charts, the same data, the same headlines. What differed was reaction. Some chased momentum, some ignored risk, some assumed liquidity would always be there. And when the cycle corrected, those assumptions were exposed. That's not failure, that's feedback. Cycles are feedback mechanisms. They show where leverage replaced understanding, where confidence replaced preparation, where speed replaced patience. If you treat that feedback as punishment, the lesson is lost. If you treat it as instruction, the cycle becomes an ally. This is why experience matters in markets. Not because it predicts outcomes, but because it changes responses. Veterans don't fear volatility, they expect it. They don't chase certainty. They manage uncertainty. And managing uncertainty is the real skill. The cycle doesn't demand perfection, it demands respect. Respect for risk, respect for timing, respect for limits. Right now, the system is still settling. Confidence is rebuilding slowly. Liquidity is cautious. Participation is selective. That's healthy. It means the excess that caused the wipeout is no longer in control. What comes next will favor preparation over prediction. Those who learned from this phase will be positioned. Those who didn't will repeat the same mistakes in the next cycle. And there is always a next cycle. That's the constant. Markets change, narratives change, assets change, cycles don't. They repeat, well, not exactly, but reliably. If you understand that, you stop chasing every move. You focus on staying aligned with the rhythm of the system. Because alignment, not urgency. is what carries you through cycles intact. And if there's one takeaway from everything you've just seen, it's this. The cycle didn't end your opportunity. It refined it. And those who adapt are the ones still standing when the next phase begins. This is where the cycle leaves you with a choice. Not a trade, not a prediction, a mindset. Every financial cycle offers the same decision at the end of volatility. React or reflect. Reaction feels natural. It feels urgent. It feels like doing something. Reflection feels slow, uncomfortable, almost like falling behind. But reflection is where the edge lives, because cycles don't reward speed. They reward understanding. What just happened wasn't a warning that markets are broken. It was a reminder that markets are alive. They breathe. They expand. They contract. And when they contract, they reveal weaknesses. Not in the system alone, in participants, in assumptions, in risk management, in emotional exposure. That's not a flaw. That's how cycles clean themselves. If you walk away from this moment thinking only about losses, you miss the lesson. If you walk away understanding how leverage, liquidity, and behavior interact, you gain something far more valuable than a short-term win. You gain perspective. Perspective allows you to survive long enough to benefit from the next phase. And there's always a next phase. It won't arrive with certainty. It won't arrive with consensus. It will arrive quietly. When participation is low, when attention is elsewhere, when patience feels unrewarded. That's how cycles work. They punish emotional timing and reward structural alignment. This series wasn't about fear. It wasn't about doom. It was about reality, about understanding that markets don't move to make sense. They move to rebalance. And rebalance, they always do. If you respect that, you stop fighting volatility. You stop chasing confirmation. You start positioning your mindset for longevity. Because the ultimate goal isn't to win one move. It's to stay in the game long enough to recognize when the cycle turns. The noise will fade. The charts will change. New headlines will arrive. But the cycle will continue. And now, you're better equipped to move with it instead of against it. That's the real advantage, not prediction. Understanding